Welcome to video number 7, Journal Entry Basics. Let's look at our roadmap. We just got done with our transaction analysis where we were analyzing transactions and keeping our balance sheet in balance. Now we're going to talk about journal entries, which is the way that accountants actually conduct transaction analysis. Journal entries are how accountants record transactions. Actually, they are identical to the transaction analysis that we did in the previous video. Journal entries are identical to that transaction analysis. There's just one difference. Remember how in the prior video we increased and decreased accounts? Well, journal entries don't increase or decrease accounts. Journal entries debit and credit accounts. So rather than increase and decrease, journal entries use debits, which sometimes we shorten to DR, and credits, which sometimes we shorten to CR. And the rule is simple. To convert increase-decrease into debit-credit, all you need is this yellow table here. For asset accounts and expense accounts, if we want to increase those accounts, we will increase them with a debit. If we want to decrease those accounts, we'll decrease them with a credit. For liabilities, equity, and revenue, if we want to increase those accounts, we'll use a credit. And if we want to decrease those accounts, we use a debit, okay? So it's two opposite ways based on the category of accounts. Each journal entry, just like transaction analysis, must include at least two accounts. And this is how we keep our balance sheet in balance. Remember how we had pluses and minuses in our transaction analysis? Well, in journal entries, we don't do plus and minus. The amounts are always positive. The plus and minus, the direction of the entry, is completely captured by the debit or credit, okay? Accountants just know how to increase a certain type of account with a debit. You increase another type of account with a credit, okay? That's just a correspondence you need to practice and you'll become more familiar with it. The good thing about journal entries is that it's easier to keep our balance sheet in balance. Why? Well, as long as for each journal entry, we're keeping our debits equal to our credits, this will force the balance sheet to stay in balance. So we analyze a transaction, we record our journal entry, and as long as debits equal credits, the balance sheet is guaranteed to stay in balance. That's what makes journal entries good and useful. So let's go to our common picture here of our balance sheet and income statement account categories. And this is just a bit of a reference sheet. Assets and expenses, okay, so now we're talking about assets and expenses. We increase those accounts with a debit. So I've put a yellow debit, DR, at the top of that. So assets and expenses, we increase them with a debit and decrease them with a credit. Now liabilities, equity, and income accounts, we increase those accounts with a credit. So we increase them with a credit and decrease them with a debit. This is just a reference which contains the same information we talked about on a previous slide. And here's another reference for you where I've put all of the accounts we've talked about on this picture. Remember, here's the asset accounts, the liability, the equity accounts, income, and expenses. I'm also going to add something useful to each of these accounts. I'm going to add a little parentheses next to each account where I put the category that account fits into. So next to cash, I'm going to put parentheses A because cash is an asset. And that's just a helpful way to remind yourself of what category each account is in. So for liability accounts, I'll put parentheses L. For equity accounts, I'll put parentheses E. And now I'm going to transition, rather than having income and expense accounts considered as different categories, I'm just going to lump them together. And I'm going to call these income statement accounts. So IS is what I'm going to say for these income statement accounts. Remember our balance sheet relationship, assets equals liabilities plus equity. There's a slight difference though. Remember in our transaction analysis, every time we adjusted an income or an expense account, we immediately flowed that transaction through to retained earnings. With journal entries, we don't do that, okay? We don't do that on every transaction. We just do it once at the end of the period. It's called a closing journal entry, so that we close retained earnings only once per year, okay? So that's going to be another slight difference between transaction analysis and journal entries. We're going to save the flowing of income and expense accounts into retained earnings. We're going to save that for one time at the end of the year. And we'll talk more about that in a future video. For now, let's talk about our transaction analysis. So let's just go through, if you remember, when we collected $300 from a customer, remember that? And we reduced accounts receivable by $300 and increased cash by $300. I think you remember that, right? Well, how do we convert this transaction analysis into a journal entry? We just use the simple rules. If you go back and look at that table, we've got two asset accounts here. You increase asset accounts with a debit and you decrease asset accounts with a credit. So this is what the transaction analysis looks like in journal entry form. We want to increase cash. Cash is an asset account, so we debit cash to increase the cash account. We debit cash. Accounts receivable is an asset account. We want to decrease accounts receivable. So accounts receivable is an asset. And in order to decrease an asset account, you credit the asset account. So this journal entry will increase cash by $300 and decrease accounts receivable by $300. This is what a journal entry looks like. Now let me put it big on the screen and talk about it in more detail. So here's that journal entry again, a debit to cash of $300 and a credit to accounts receivable of $300. This will increase cash by $300 and decrease accounts receivable by $300. What are we seeing in this journal entry? Well, the first thing we're seeing is a formatting convention, which is that we typically put debits before credits. So this is just by convention. Whatever account you're going to be debiting, let's put that one first, and then whatever account you're crediting, we'll put it second, okay? Debits before credits. What else are we seeing? Well, we're seeing the DR to just tell you, yeah, we're debiting this account. In case the formatting doesn't make sense, we'll put a DR there so people know that we're debiting. Then we're going to put the account name, which account are we debiting, and what is the category of the account. So we're debiting cash, which is an asset. We're crediting accounts receivable, which is an asset. The other thing we need to know is debits are on the left, credits are on the right. Okay, that's just by convention. Debits are on the left. Debits are first and on the left. Credits are second and on the right. Okay, that's this formatting rule, and this is just by convention. The other thing you need to notice for every journal entry, debits have to equal credits. So 300 equals 300. You need to make sure whatever accounts you're debiting, the amount you're debiting is the same amount that you're crediting. And the good thing about journal entries is if you do this, your balance sheet is forced to stay in balance. There are three types of journal entries. There's general journal entries, adjusting journal entries, and closing journal entries. In the transaction analysis, we've gone through general and adjusting journal entries. General journal entries are those when the transactions occurred during the year. We're just going to record journal entries. Adjusting journal entries we typically do at the end of the year, and it's because time has passed. So if you remember when we depreciated PP&E, that was an adjusting journal entry. The only reason we did it is because time has passed and it was the end of the year. So we need to reflect the loss in value of our PP&E. That's just considered an adjusting journal entry. The closing journal entry zeroes out income statement accounts into retained earnings to balance the balance sheet, and it's only performed once at the end of the year. That's the closing journal entry. So that's it for the basics of journal entries. Next, we're going to convert what we did in our transaction analysis exercise. We're just going to convert those into official journal entries. So that'll be the next video. I'll see you then.